After yesterday breaking through 4,000 for the first time in a year, we're now closing just a touch above 4,000. I mean, literally just 1 point above 4,000. But nonetheless, psychological things are important, and we're closing above 4,000. That is important. But is it going to last? Is it going to stay? Well, there's a number of questions we have to ask, and two of them seem to be centered around, and two of the most important seem to be centered around the notion of higher yields and the notion of a recession. Let's attack both of these. First, higher yields. I thought that when the 10-year got above 3%, I changed my tune over the last week or so and believed that was going to cap out. And I thought it was going to cap out because the Fed members were saying that the bond market was pricing in a lot of what the Fed was going to do. So they came in more dovish than the market was anticipating. Then all of a sudden things had to reset a little bit. And that's what we saw last Wednesday. And obviously we saw it reverse. But now I think we're getting back to what should have continued from last Wednesday. We're seeing bonds pull back, noticing that the Fed has taken, or maybe they've walked it back because the market didn't like it, whatever it is. They aren't indicating any 75 basis point hike. And I think last Wednesday, the market was anticipating, and as a matter of fact, JP Morgan was expecting a 1/5 chance of them doing it at the last meeting, that at least the Fed would hint at future 75-point hikes. They basically did the opposite of that. All the talk about 75 basis points since has been, we're walking it back, but nobody has seriously said they expect or want to do that 75 basis point hike. So I've seen no indication that that's going to occur. And I think the market, at least the bond market, which is bigger than the stock market, typically acts more rationally than the stock market. It's less liquid, less retail, etc. Is beginning to price that in. We're now below 3% on the 10-year. The market is finally starting to at least look like it's getting some footing. Hopefully, we have hit a local peak in bond yields. That can calm down. And I think if yields can calm down, that can allow people to stabilize mentally and can allow the market to rally. Again, the big reason why the market is pulling back and has been pulling back all year is yields. The big reason why a lot of 10x growth stocks, besides being ridiculously overvalued, have pulled back for over a year is the fact that they feared future rate hikes and future tightening, future Fed action. So I hope that addresses the bond yields side of the equation. The other side of the equation is the recession question. A lot of people are saying, rates are going to go up, the economy is going to contract, people are going to get fearful, inflation is going to be high, and therefore we have to have a recession. As of right now, I'm not expecting that to be the case. Why am I not expecting that to be the case? Jobs are incredibly strong. There's 1.9 job openings for every one person that's looking for a job. Wages are up. Inflation may be peaking. Spending on travel is up 60% year on year. And I know last year was a little bit of a weird year, but April wasn't that weird of a year. Last summer was not that weird. April's kind of when people start planning those vacations, and 60% is quite a large jump. So, something to consider. It doesn't look like there's a large tightening of the belt yet, and that can certainly happen. But it, in my opinion, can only happen if there is increase in the unemployment rate or massive fall in wages, which there is no sign of occurring right now. So if jobs remain strong, which basically is guaranteed given the strength of the job market, we can even experience class, etc., that has not been benefiting so much from rising wages and inflation. So consumer spending is strong, consumer balance sheets are strong, jobs are strong, interest rates are stabilizing. I don't see any, massive economic contraction occurring right now. 2023, maybe it's possible, but I don't think the market's going to get ahead of the recession, the recession that occurs next in the lineage of time. There will be a recession at some point, but I'm not convinced it's going to be this year. I'm not convinced it's going to happen we're leading into it, or that it was last quarter. Last quarter had a lot to do with, foreign exports, strong dollar. We're probably not going to have good foreign exports again. Strong dollar's even stronger now than it was last quarter. I think the fundamentals are okay. I think things are holding up okay. We'll see what CPI looks like tomorrow. That's really a moment of truth. If we get a light CPI, if CPI isn't super hot, I'm not saying the market's going to have a mega rally. It might have a rally. But what I'm saying is the weight of inflation, the weight of fear around inflation going up, and then the Fed having to get super tight, and then bond yields rising rapidly with no end in sight, that weight, which I think is the primary weight that's keeping the market down, is going to be lifted. It's going to calm down. And once that weight kind of gets off our shoulders a little bit, things can stabilize, people can get comfortable, the sellers won't be in as much of a panic mode, and then all of a sudden we're going to look around and Disney's trading at below pre-pandemic levels, all the way back to 2018, 2019 levels. And it's a phenomenal business, and we've seen Disney Plus be successful. Even with Netflix selling off, Disney has more legacy content and offers a different value proposition in addition to travel, cruise lines, parks. We talked about 60% year-on-year travel spend increase. Disney's got a fantastic business, yet again. However, it is trading at trading at pre-pandemic levels. Very attractive valuation, if you ask me. I get it. They've suffered the last 2 years, but you got to buy when things are looking tough. That's like when the opportunity is. The opportunity is not when a company is firing on all cylinders and stock's up 100% in the last year or two. That's not the time to buy. I mean, maybe it is. It can be, but the best time to buy is when bearish sentiment is at the highest in over a decade, and there are more stocks down 75 and 90% than there were at the March 2020 lows. The only time in the last 25 years this has been exceeded was in the 08-09 recession and the dot-com bubble, and we're almost at those levels in terms of stocks down 75 and 90%. I think there are some fundamental reasons. Yes, bond yields have gone up. We have to adjust valuations because of that. Bond yields are still low though, and I think this is a little bit of a scare, and things may have overshot to the downside. Sentiment might have gotten a little too negative. We'll see. We've got a big moment of truth tomorrow. Hopefully it works out positively for the bulls, and we do get that stabilization we're looking for. Today looked like it was an early sign of potential stabilization that can happen if we get the facts right. We had a market that opened up, chopped down, chopped back up. Let's see what happens tomorrow. If we get a peak inflation type of reading tomorrow, I think that's a bullish sign. It allows things to calm down, it allows people to calm down, takes the pressure off the market for a little bit, particularly off the bond market. It doesn't need to keep going up and literally look like it's going to the moon. We can chill. We'll see what happens tomorrow, and until then, peace out.